Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Brian.
Brian, you and me today, we have a lot going on. So we have the election that just concluded last week. You have now the White House, and you have the Senate and the House of Representatives in place. And all of that actually means something to mortgage and real estate. So we're going to talk about that, unpack a little bit of that today. There's certainly, at the top, I want to say there's a lot of things that we still do not know, but we're going to talk about the things that are happening right now and then kind of figure out what does that mean for maybe charting a course moving forward. Sound good?
Sounds good.
All right. So we're going to go with the first thing from the top. This is from Realtor.com. Donald Trump will return to the White House. What his presidency means for the housing market. So lots of stuff in here. Now, there's a couple things I think we need to make sure we clarify and then unpack for some people. But let's first talk about the housing kind of crisis, if you will.
Right.
We have for a long time talked about affordability and people's mathematical inability to afford because of their wages compared to the debt-to-income ratios required to qualify for a home. We've talked about down payments and how much more you have to save because the price of homes now at $800,000 means if you're saving 20%, now that's $160,000. We talked about credit. We've talked about consumer credit. We've talked about interest rates. And some of the things that I'm mentioning even right now aren't going to be fixed by whoever the president is. That's my first statement. Second statement is their suggestion here in Realtor.com is mostly offshoots of policy that's proposed that is not in place yet.
Yeah.
So disclaimer.
That's one of the biggest things that I did want to signal out was that a lot of the things are still being speculated as to what is going to happen, what's going to get passed, what's actually going to work, what's not going to work, what's just completely, chit chatter. And I really think that once we have, the transition of presidency, we know what policies are going to be taking place, what's actually going through, we'll have a lot more of a clear idea of what direction the market's going, because I feel as of right now, it isn't, what we would think it is or what you might think it is just, off the switch of presidency. But there's still a lot of information pertaining to inflation, to the deficit, to the expending and switching of the administrations that all play a big strain on, the direction of where the market's going to go.
Yeah. So, okay. So let's talk about the first thing that they brought up here, which was the mass deportation of immigrants. First of all, Realtor.com, you need to do a better job. This is not mass deportation of immigrants. It's of illegal immigrants. I don't know if that was convenient or if that was on purpose. You need to do better. There's a big difference, especially in housing, of wanting housing for immigrants versus illegal immigrants. Also, in our process of approving people, there's a big difference between immigrants and illegal immigrants. So we need you to do a better job and maybe even correct this if you have not already.
Yeah, please, because that's the things that, get people alarmed and start thinking about things that are completely not attached to what they're talking about. Like that change of words completely just opens up the door for a whole bunch of other people to worry when there's no reason to be worried.
A lot of misunderstanding,
yes.
A lot of heated emotions. And again, this is not a dehumanization of anybody at all. It is, you need to be clear about what we're talking about, especially when it comes to housing and real estate, whether we're talking about illegal immigrants or people who have legally immigrated here. Yeah. Big difference. So basically, the whole point here, though, is that the mass deportation of illegal immigrants would be a leading indicator to reduce demand. But I'm not sure that it would reduce demand in the purchase market more than it would in just available housing and shelter in general. What do you think about that?
Well, I mean, illegal immigrants from the beginning can't purchase a house here in the United States because A, they don't have a social security, they don't have stable income or, a job history to be able to pull, let alone significant down payment to be able to, invest towards a property. So therefore, I feel it's very inaccurate that they're stating it like that because in reality, it's just Americans in general that need to buy a house, that want to buy a house, or that can't buy a house because in reality, like illegals can't purchase.
Well, and I
don't mean illegal immigrants, not illegals in general, just to correct my language,
yeah.
But I mean, it's kind of like, that makes no sense.
Well, and I have a lot of friends who actually immigrated here and have bought a house here because they became legal citizens.
100%.
And so there's plenty that have been able to buy a house because they then did what you're talking about. Get a job, save the money, put the down payment, buy a house, have a piece of the land. Okay, so the deportation thing here, I don't think solves anything. Actually, I don't necessarily think it reduces demand from the purchase market. It might relieve some demand from just the need of shelter in general. But even if that, let's just say they mass deport millions of people. That might provide some localized alleviation. It doesn't generally do anything for the affordability crisis. It doesn't
No, it doesn't at all.
It doesn't do anything for interest rates. It doesn't do anything for home builders.
There's no correlation. There's no connection between those two things.
So I think this point is less about real estate than it is more of just a policy response from Realtor.com, and that's fine. I understand having a policy response because you're in real estate. That's great. But again, it doesn't. I don't think it reduces demand as the argument might sound, as much as the argument might sound like it would, and it doesn't increase affordability for the rest of the population that is looking to buy. The other thing is, I want to just read this quote out, and then I have something to say. In the short run, reducing immigration could severely hurt the labor supply needed for new home building, since up to a third of residential construction employment consists of foreign-born workers. Now, here's the thing. Foreign-born workers, again, does not mean illegal. And the misuse of the terminology is going to create problems because people are going to argue in the comments and get at each other when this could be clarified very simply. And this went to market in this way, even though it's a quote. I get that. But we need to be super clear here. The difference between foreign-born workers and illegal immigrants, they are not the same thing. And I really do expect our participants in mortgage real estate to get this a lot better.
And just to add on to that, it's signaling that if they are having illegal, workers on there, then that means, that's unlawful and that shouldn't happen as well.
Yeah, but okay, you can tell I'm not going to say his name, but you can tell my friend, I'll say Jay. You can tell my friend Jay, just because he's foreign born, he can't work here? No, he became a citizen here. So it's not that he's foreign born. That's not the problem. Nope. That's not it at all. But again, that's what they're saying, which is just inflammatory to most of the people that are watching this kind of topic around the internet right now.
If they have a Social Security, they work, they pay their taxes, they're able to contribute to our taxes and our economy and our society, then therefore they are lawful and should be employed and should be able to have the benefits of an American.
Yeah.
Now, on the other hand, I'm not saying that if you're an illegal immigrant, you can't have the opportunity to have that. It just requires a different process. And in this argument, in this context, it has nothing to do with what we're speaking about, because I feel there's no connection and there's no benefit. There's nothing that we can extract from it. It's really irrelevant to the subject that we're talking about.
Well, and the downline of this, or the domino effect of this too, when you're talking about the labor supply needed for new home building, that goes up and down the chain too.
Yeah,
it goes to supervisors and managers and specialists in lots of trades, not just people swinging hammers. You're talking about plumbers and electricians, you're talking about people pouring concrete, you're talking about foremen, you're talking about people doing framing, roofing, solar, landscaping, like stuff, interior design. Like housing is so comprehensive when it comes to taking literally a piece of dirt and making it level to build a house on so that someone could live in it safely and meet all the regulations. This is an upstream and downstream conversation. So I think it warrants a little bit more consideration than what we're given here. So can we move on in this article?
Please.
Okay. So cut regulations and open up federal land for building. All right. Now we've talked about this. We talked about this at the beginning of, maybe the end of 2023. We did this in 2023. We're talking about our predictions for 2024. Remember that, Brian? We're talking about what's going to happen in the new year. And I was saying like there's going to be more creativity.
Build.
And we need the municipalities and the government and the local municipalities and the builders and the banks all play along. So I think that's what this is. That seems what that proposal seems to be what that proposal would be.
One of the things that I read, from the article and what I get the sense of is that a lot of the things that the administration that's coming is saying that they're going to do or have been quoted that they're going to do, it gets downplayed by the people making the article, because they say like, oh, it wouldn't work because of this, it would not work because of that. But in reality, I just feel that as long as something's getting done and they're trying, it's a lot better than having it's not 30% for the cost of a new home, but it's still significantly higher than what it was a few months ago.
Yeah,
a few years ago.
That seems pretty high. That just the regulatory expenses are about 30% of the property cost upon the purchase. Again, that's very relative, I'm sure, place by place, because regulations in municipalities like San Diego, Los Angeles, let's say Dallas, Texas, Miami, New York, that's going to be way different than in some more rural areas where there maybe are not as many restrictions when it comes to housing and the permits required, et cetera, et cetera, et cetera. You have here, many economists agree that streamlining and eliminating regulations would help boost home construction and reduce costs, though it's difficult to imagine achieving the extent of price relief that the incoming president is envisioning. I think it's a little bit high. I think it's upstated that it's 30%. I don't think it's that high. It could be as much as 10% based on just what I know and the things that we're connected to and people around here building things, or even ADUs, our friends that are contractors. Like, yeah, there is permit costs. You do have to pay the school district some expenses for increased tax. You're increasing your square footage. You're going to get reassessed for that square footage. So there are, let's say, non-labor and non-material costs that go into building that are a percentage of that total cost.
And I mean, and beyond the bold promises and, you know, the statements that are being made, whether they're true or accurate or not, you know, I just feel that this is the problem that everybody's experiencing, that everyone is feeling. And even though, you know, whether it gets done or gets done, there's being steps forward to how do I say it, to be able to alleviate the pain points of the Americans that are, you know, not being able to, you know, get their house, not able to pay their bills, not able to, you know, pay their rent. So I think anything that is moving forward or helping bring the cost down or even giving ideas of, you know, what can happen, what we can do, that's all positive things that, you know, gets the ball rolling so that we do find solutions. We got to try something. I think it was one of the presidents that said, try something, and if it doesn't work, try something else and keep trying until something works.
You're going to have to.
You're going to have to. Unless, and if we know that it's an issue and, you know, like, you know, cutting regulations, that's great because we know we have a solution at hand. It's just people are hindering themselves, or I don't know why they don't want to, you know, open up that land or, you know, those restrictions to be able to accommodate for more housing.
Yeah, I mean, so yeah, some of those things are going to get tied up in bureaucracy and courts and that kind of thing. That's just kind of part of it. But if you can loosen some regulatory stuff and you can maybe increase some land, you will be able to make the argument and lay claim and then see the result that you could actually cut prices. I don't think you're going to cut prices in half.
No,
that's way too far. It's not even, you know, maybe 20%. Not even, that's too high too. Maybe 5, 10%. That'd be helpful.
But anything helps, you know, rather than it going up. If it comes down a little bit, anything starts to help gradually.
Well, and people don't want to look at it this way, but really, housing is really a team game. You know, the city's got to be involved, the contractor's got to be involved, the developer's got to be involved, the architect's got to be on the team. You got to put all the right players on the field. You got to run all the right plays, and you got to be able to hand keys to a family at the end of all that at some point.
Even in the neighborhood level, like the neighbors, they all have to obviously, you know, have some sort of communication. One of them can put their house up for sale, and it could completely just, you know, mess up the area, or lower than, you know, somebody's putting it just to, you know, get a little bit more competition. That all plays a part as well.
Dude, around here, if you want to build anything in San Diego, there's going to be a public hearing.
Oh, of course.
You're going to be able to have a town hall and a public hearing and vet the idea, and you're going to hear questions from citizens and neighbors, and they're going to ask you all the hard questions. You're going to have to stand up and answer them. And I'm not saying I'm not being a sympathizer. I'm just saying that's part of the process.
Yeah.
So that being part of the process, there is the potential for cutting regulation to increase more housing, but it's still going to go through all the same loops, or not loops. It's the jump through all the same hoops that you'd have to if you were going to build in your normal circumstance. Until that changes, it has not changed, and you should expect that they're going to have to go through all the normal crossing your T's and dotting your I's.
As they should. But I mean, in that sense, I feel that, you know, for permitting, for regulations, for access of building and things like that, you know, inspections, special inspections, there is enough resources, and we've seen how resources get allocated for the help to be, you know, granted, for people to get hired to do these expedited processing for, you know, permits, plans, inspections. So I feel that we're just not taking the right measures to be able to allocate the right funds, because the money's there, I believe. And we've seen the country, states, cities spend fervently. And I just feel that, you know, if we allocate the right resources to the right places, a lot of these things will start getting alleviated. I'm not saying they'll get fixed overnight, but it's the start.
I think it's just going to take one or two things. I think it's either going to be a policy, and then it's going to be a developer or a city that's going to go first. And then it's kind of like when one person goes through the door, everyone else can go through the door too. And I think that when that kind of happens, it'll create some momentum. And I'm looking forward to that.
Yeah, no, 100%. I'm right there with you on
Let's quickly talk about the pressure for the Fed to lower interest rates.
Yeah.
This one I have, I have a nonpartisan appeal on this one, which is, first of all, number one, the president does not set interest rates. Number two, Jerome Powell sets the Federal Reserve's overnight lending interest rate. He does not set mortgage rates either. But both of those people can be very vocally, publicly about what they think should happen and how it should happen and when it should go where and why. And right now, there's some tension between those two guys.
You know, yes, there is.
Already.
Yes, there
Already.
is. Yes, there is. But you know what? I'm kind of glad there is, because it's going to go back and forth. It's going to go back and forth, back and forth. I need you to do this. We can't do that. I need you to do this. We can't do that. And eventually, they're going to have to come at a meeting ground, at a middle ground, to see what they're able to do. But at the same time, we know.
But hold on. Who's going to budge between those two? Who? Honestly, you think Trump's going to budge, or you think Powell's going to budge?
I would favor Powell to budge more than Trump.
You would favor Powell to budge more than Trump. Yep. Why? Because of backroom pressure, public pressure. What do you mean? Why do you think that?
Well,
he's less stubborn.
Well, not I mean one no, but Trump is stubborn, and in certain things he's gonna just say either my way or the highway, and there's enough friction in between both of them that I feel Jerome Powell's gonna have to cave in, because he does have the weight of, you know, the economy on his hands. as far as the president, I mean, yeah, he could be grilling him, he could be putting that pressure, but the last say does go from the president, Jerome Powell, from the Fed chairman.
President.
Yeah, the
Fed chairman. Yeah.
Yeah. So I feel that he's already been grilled throughout this whole time. So I feel he's like, at this point, something needs to get done. And that pressure is not so much, I believe, the back room, but it's also just everything that everybody's just waiting for. Like, please just bring rates down. Do something to alleviate this in conjunction with the president. What are you guys able to do? I think it's more of a let's work in a team. And right now it's just very, very, very early on in the game that I feel like you're gonna do. I'm not gonna. And then once it's game time, they're gonna have to come to some sort of agreement or like, hey, I don't agree with you, but we're gonna have to agree to disagree, but we're gonna have to get shit done regardless.
So a couple things. First of all, I think that they actually had a happy accident that happened along the way. For many months they've been quarters. I'm gonna say quarters, not even months. Many quarters in a row, they have been saying, the Fed has been saying, we're gonna look at the data. We're gonna be data reliant. We're gonna look at and see what it's telling us, and then we'll make our next decisions. I think that's also kind of become a secondary benefit to them to go, regardless of who's the president, we've been data dependent, so they can kind of have a nonpartisan position. I think that's mostly been the case. I know there's lots of arguments. I've read both on pro and against the Fed about that.
Yeah.
That's for something later. That's not for right now. My point in that is that there's going to have to be some symbiotic relationship here, because if you are going to set forth economic policy as the incoming president, that then would require rates to be in a certain range in order for them to affect the outcomes you're hoping for, then the Fed would need to play along with that. Or if you're saying, oh, well, I'm going to be the incoming president, I'm just going to hitch my wagon to whatever the Fed says, then now you're going to be whipsawed around by whatever the economic outcomes of the Fed decisions are, which, again, may not necessarily play into the policy changes you're hoping to have effect by having the rates go where you want. Yeah. So I think there's going to have to be some working together, even though there's stubbornness on both sides.
I agree.
I really think so. So, I think the posturing and the news headlines right now is very interesting when it comes to Powell and Trump.
Yeah, I saw one that said, Powell dares Trump to fire him and try. Like, I'm like, whoa, it's like a telenovela out here, dude.
Well, and again, it doesn't necessarily help you to throw someone into that position that's just going to, be like a lapdog. Because, again, you can't just have a lapdog that's going to say yes to everything when your idea is bad. So it has to be for ideas that are economically going to work and actually cause change that's positive, bring down national debt. You're going to have price stabilization without saying price stabilization, because you can't have like certain caps on things, whatever. There's so much inflammatory rhetoric that's being flown around that it's really becoming more difficult for people who don't follow this regularly to kind of see through all the garbage that's being tossed at them.
Oh, 100%. I mean, that's another whole story we get into.
And I say that mostly about like the price controls thing. Like this whole grocery store thing that I hear everyone talking about, and eggs and milk and bread, and like the whole thing, like it's the staple stuff. It's the at your dinner table kind of conversations. And yeah, okay, I see those things go up, and they've been more expensive now than they were a couple of years ago. I don't see them going back down. Yeah. I see their price increase slowing. I see inflation slowing, but I don't see any negative sign in front of any of those over year. So until that happens, we're not returning from $6 organic milk to $3 organic milk. It's just going to be from $6 to $6.05, then to $6.15, $6.30, and $6.50. So that's just a slowing of inflation. It's not a return to the price that it came from. And so the inflammatory rhetoric around that, I hate. Inflation is down. Inflation is down. No, inflation has slowed. Inflation has slowed, not gone down, it's slowed. And then you talk about these like dinner table topics, like they're really nothing, but they're just primary examples that then are the part of an entire family's budget. It's not just that. Yeah. It's that gas is more expensive. It's that the rent is more expensive. Insurance is more expensive. Literally everything has become more expensive for large swaths of Americans. Pressuring the Fed is going to help when it comes to the things that they've borrowed against, but it's not going to help in the everyday spending items until a long time from now. Took us a long time to get to where we're at with the Fed rate, with consecutive rate hikes month after month after month since March of 22. And now it's going to take months and months and months and months to get us back away from those highs that we saw.
And it's not going to happen overnight. We're already seeing mortgage rates stay higher than usual. And I just feel that, like I said, until we really get, some actual policy moving, we get some more stuff rolling that's actually concrete, and it's not just speculation from what's going to happen into the next presidency, a lot of things will be more clear. And I think, moving into this year, I think it's going to be still so volatile because the exchange of presidency, what are they going to do to switch it over, and what can happen in these next couple of days So a lot can still happen. And I feel that once there's a lot more stability and they're more secure, plans, things will kind of start easing out.
Yeah, I don't agree that there's gonna be the ability for Trump to strong arm Powell. I don't think so, because it's not just Powell. You have all of the other people involved in the Fed that do make public comments, that do talk to economists, that do talk to politicians, that do talk to business owners, and do talk to regular people. And it's like it's not he's just the guy who comes up and he's a spokesperson.
Yeah,
he is the chairman, but there's all these other people involved in the process too, and they don't always vote the same way. So that's you got to remember that.
And that's what I like about it, that it's not so much I feel that they need a strong arm, but it goes back to they just need to come up with a combined solution.
Well, I know. I'm saying it because that's his trend. Like that's his style. I'm just going to strong arm this guy, do this gal do. I don't think that's going to happen in this case because there's too much at risk. And I think that there should be some more, if it's not going to be him, someone else on his administration should have a what am I trying to say? Have their head on straight and untemperamentally make some quality suggestions economically that then the Fed can get behind and they can take co-credit versus just being strong-armed. That's my point.
Department of Efficiency.
Okay. Can we move on? Let's move on. All right. The next article here, Brian, is the Federal Reserve cuts interest rates by a quarter point after the election. Here's what that means for you from CNBC. Second article of the day. Federal Reserve cut its benchmark rate by 0.25% or 25 basis points at the end of its two-day meeting. And economic anxiety was a prevailing mood heading into the U.S. presidential election. Lowering borrowing costs may offer some relief to struggling Americans.
Well, I'll tell you what it's not. It's not lowering mortgage rates.
That's true.
And, I'll remind you guys that the Fed, the president, doesn't set the mortgage rates. They can influence based on, the decisions they make, the things that they say, but they themselves don't generally, they don't at all, set the rates.
Generally, no, they don't at all.
No, I'm just kidding. No, but on the contrary, you follow the 10-year, and since July all the way up into November 16th, literally the day that they announced that they were dropping rates, the market has been going up as far as rates. I mean,
yeah,
and it's rather how do I say, it's rather alarming, because usually you would think that rates are going to come down. But moving into the new presidency and the new year, everybody's like, yo, well, what about inflation? What about the deficit? What about spending? What about, policy? What's all these things that are going to happen that are going to either help us or not? Because they're saying, yeah, with Trump, we're going to have faster growth, but we're also going to have a lot more spending. And that's the thing that right now it's holding on the markets, that is like, yo, like, okay, it's good, but then we also know what comes with that, that presidency. So a lot of it is still very volatile, and I think very uncertain. I mean, I've seen it in the mortgage-backed security. We're up one day, we're down the other day. It's literally up and down, up and down.
And it's been wild too.
It's been so wild, Andy, since literally September 16th. It's been up and it's been down. We've had some losses. We've had some really bad losses, followed by some good days, but we haven't been able to recover to the levels that we were in August. You know, we were touching almost the low fives into the fours at certain loans or certain credit scores, but now we're right back up to that sevens, high sevens, high sixes, which a lot of people, again, go back to the it's out of my range. Now I have to wait again until the next dip. And I think that's what's been happening throughout the year. And we've been very good at calling it out and following that, there's going to be dips in the market. We're not going to have straight drops and tanks, but there's going to be dips and times where you're going to be able to get in there, get a decent rate for the market, and then, make your way forward.
Yeah, I think there's a couple things here I wanted to mention about this. The great commentary, Brian. The first thing I wanted to make sure I mentioned to everybody is that this was already predetermined. They had already decided this. I know they're saying, they were going to announce their rate drop after a 2-day meeting. I think they kind of knew going into it. I don't think the outcome of the election, honestly, I don't even think they were expecting to have the outcome of the election known. I don't think they knew that. But I think that, again, if they're being data dependent, then the election kind of exists out here, and they're just like, okay, what do we have to make our decision on? So I really think that this 0.25% rate drop was already expected. I do think they'll probably make another one in December as well to kind of end out the year so that they can show that they're not going to be coerced by whoever the outcome and the winner was. I think they do it for that reason, and that reason in conjunction with the data dependent reasons they're talking about. Yeah. I think those things two combined make a very strong case for them to say, you know what, we're going to go ahead and do our another 0.25% rate reduction at the end of the year, like we said we would, to achieve the soft landing. Quick note here. I want to talk about the soft landing because inflation is a big problem moving forward. The spending, like you mentioned, is a big problem moving forward. The real question in the tail of the tape at the end of all this is going to be what programs get cut, how many people get cut from departments, how much money will the government save by doing that, and then what other additional revenue streams are coming into the United States to offset the additional expenses that are being proposed. Because there are additional expenses being proposed. What are they going to be offset by? I'll come back to that in a second. What I wanted to tell you, though, is that one of the things I'm looking at is that the inflation that we are being told is falling back or going down is just slowing. I want you to remind that. I want you to remember that. I want to remind you that this is like flying on an airplane at 20,000 feet, and then it goes from 20,000 feet to 30,000 feet really quickly, and then it goes from 30,000 to 33,000, then to 35,000, then to 36,500, then 37,000. It made a really big ramp up, and I think what we're having here is normalization of pricing.
Yeah,
and that's my point. I want to make sure that I'm saying this on the record, and I can eat my words later in the rearview mirror, coming back to this however long from now, and I can be wrong, and that's fine. I would love to be wrong. But I think that what happened is in the last 4 years, we had such a rampant increase of prices across the board. And now this slow tippy-toeing our way, continuing on that direction, this is on top of that massive height increase we already had.
Oh, yeah. Milk, $6.50 a gallon? Yeah, that's fine.
Well, it's not $6.50 everywhere, apparently. We just live in stupid California.
No, I know. Oh, organic milk? Yeah. $7.99.
Now, here's the thing. I wanted to remind everybody, if you don't know how long it took us to get here, it took us 2.5 years to get here, okay? It's going to take us that long or longer to get out of all this if we get out of all this. The price normalization is for a reason, and they're using language to tell you that that's what they think is happening, and I'm going to tell you about that in just a second, because I think I wrote it down here somewhere. I don't know where I put it here in my notes, Brian, but I was like, oh, this is a signal that they are, because getting inflation down and getting rates normalized is going to help getting the housing cycle normalized. So as it relates to housing and as it relates to money, if they're talking about getting it normalized, that means that they want us to start expecting this as the new normal.
Yeah,
here we go.
It's slowly ways of conditioning people to say, hey, well, this is the new norm. Hey, this is what we got to get used to. We've already been through it for 2 years. Okay, it's okay. It's fine. We'll figure it out. And unfortunately, some people, they have no choice but to figure it out. And you have to keep moving forward. Life's going to keep going on. Like, they're not going to drop prices for anybody. And as you see, it's going to take a lot faster to get down than it is.
So Fed rate cuts are going to help us in a couple of different ways. I am concerned that it's going to lock in the inflationary prices that we're at now, the elevated prices. You have credit cards here. Trump announced a 10% cap on consumer credit, which is essentially a flat rate.
So I want to,
but that has to be enacted. That has to be enforced. The companies have to. I mean, that again, that's one of those things you can lob that out, but like making that happen, that's a lot of work that needs to get us there.
Oh, 100%. But to that point, I just had a conversation literally before this podcast, and one of the things that the rate cuts will help regular Americans is with their credit card interest rates. With what they're paying on interest. I had a call today, and one of my clients was like, "Hey, I want to sell my house. Over the last 3 years that I've owned the property, I have racked up a few debt." And he's like, "It's not that I can't pay it off. It's just the interest is killing me." Like, he literally said that. He's like, "The interest is whipping my butt." He's like, and I literally want to just get off. I just got a job raise. I just want to, sell my house. I want to move into a different place. I now have a higher net worth. I got a few raises along the way. So he's like, the interest rate is killing me, dude.
Wow.
And another conversation I had with another client was between a HELOC or a HELOC or a cash out refinance. They wanted to do a cash out refinance. They wanted to do a HELOC, even though their payment was only going to go up $400. Their payment was going to go above $5,000. Their current payment was $4,600. We looked at the cash out refinance, and their payment only goes up $400.
Oh wow!
But you're paying either a 5.75 rate on a cash out refinance or a 10 to 11, 13% on a HELOC. What I told my clients, and they asked me, they're like, well, what do you suggest? Well, I'm like, down the line, either way, you're going to have to pay the HELOC by refinancing it into the loan or paying it all lump sum and, not using it anymore. My advice is, you're paying more interest on your debt if you're going to consolidate everything in the HELOC because your rate is 10%. So what's more important, the rate or the monthly payment? They were like, well, the monthly payment, because I'll be able to have more cash flow and I can afford it. I'm like, well, then the cash out refinance is going to help you. You'll get a lot more tax write-offs, benefits as well for you doing the refinance this year. And then down the line, we could do a rate and term and then bring the rate back down, and then we don't have to do anything else after that. This would be like a temporary Band-Aid. But she wanted the two options between the HELOC and the home equity line of credit. But in this instance, even though it's only $50,000 that they're taking out, it makes more sense to just put it into the property, pay off all your debt at a lower rate, and then
right, because their out-of-pocket expenses are dramatically decreasing month over month.
Yeah, exactly.
Wow, that's crazy. I mean, again, it's not crazy. I mean, yes, I'm saying crazy because no matter how many times you guys tell me these stories, they're still happening. And we've been talking about this all year long, and people are going to use their house as kind of like their get-out-of-jail-free card financially, and they keep doing it. And people are just in this situation. And I totally understand that. You know, I understand that, you know, making ends meet and doing the things you need to do and letting the house pull some heavy weight, I 100% understand that. We need go ahead.
The crazy part is that combined income, they're bringing in like $220,000 a year.
Yeah.
So
That's wow.
Just to let you guys know and give you guys some perspective, you could be making good amount, six figures, you know, and you could still be hurting, you know, just because you make a lot of money doesn't mean you don't pay a lot of money every month. You know, it's everybody's, I still truly believe that everyone's struggling in their own battles in their own way. No matter how rich you are, how successful, how, you know, big you are, there is issues in every aspect in everybody's life. Nothing's perfect. So just know that everybody's silently hurting somewhere or another.
Size of life and size of spending.
Yeah, 100%.
So decreased Fed rates are going to help in other areas. To round this out, Brian, we're going to have reduced auto loans, mortgage rates maybe, but that's just more as kind of like a secondary effect of general economic stuff happening with the bond market. Go ahead.
No, it's just, I think it's so crazy how we don't look at the perspectives of how, you know, a car loan, a credit card, a personal loan are so high in interest, yet we're willing to utilize those types of financial ways out rather than utilizing one that, you know, is the most secure thing that you're going to for sure always pay, that you live in, that you utilize day in, day out. I mean, you can't live in your credit card. You can't live in your personal loan. And you could definitely, I mean, you can't live in your car, but come on now.
Your credit card doesn't give you a lot of shelter when it's raining.
You know what I mean? So it's like, I understand the logic between like, okay, I don't want to, because I'm never going to pay my house off. But then again, like, well, are you ever going to pay your debt off if you're always using it over and over again?
Yeah, it's just recycling it.
Exactly. It's a revolving debt.
Well, yeah, there's other parts of the economy and your personal spending that are going to benefit from the Fed decrease. I do expect there will be another one in December, and then we'll have to see what quarter one of 2025 looks like. I really, really want to know. I cannot wait. This is so nerdy. I hate this. I cannot wait for getting into January, February 25 so we can look back at fourth quarter of 2024.
Yeah.
I think so much stuff is still yet to change, even though we only have like 6 or 7 weeks left in the year. That sounds like a very short amount of time. That's a lot of time for stuff to change, especially also coming into what we call spending season. So
that's what I'm kind of like, like it's going to be interesting, those numbers again.
Yeah.
And remember last year we broke records because everything was just more expensive.
Everything's more expensive. The spending was all-time high. Yeah, it's crazy. Spending all-time high in personal debt's all-time high. Credit card rates, credit card balances. Good times ahead.
America's that meme right now with the fire dog. Yeah, this is fine.
The dumpster
we're okay.
Him. Everything's fine.
Everything's good.
Okay, Brian, is the Fed cutting rates why mortgage rates are rising? This is from the New York Times, which I don't normally cite the New York Times because they don't write a lot of stuff that we could talk about. But we're going to go ahead and talk about it. Mortgage rates basically jumped because we have the, let's say, uncertainty of who is president kind of out. But this is a projection that there are not as many economic headwinds ahead as everyone thought there might be. So who's wrong? The analysts or the data? What do you think?
Well, I'm going to say the analysts because they could be biased. The data is going to be the data, and it's going to report the numbers. As long as the people reporting that data is accurate, it's fair. I trust the data.
So if you're saying if it's being truthfully measured, man, you're being really veiled in your comments, but I got you. Okay. So mortgage rates tend to track the 10-year yield. If you, I don't know if anybody here was watching the 10-year yield. Just me? Okay,
no,
just me.
I watch it all the time.
I'm saying to you guys, I'm sending you guys screenshots and voice notes. Okay, guys, if you watch at the top of the channel here and at the bottom.
But no, it's funny because like if you understand that that's the best way to be able to predict where rates are going to go, I mean, you go look at that thing, it's pretty freaking accurate.
Unless it changes its course and it changes its pattern, rates will decrease coming into the brand new year. In January, February, I mean, let's say 10 to 15 weeks from now, the projection I put on the chart I sent you guys is that mortgage rates will be going down by that time. It will have to completely break trend out of its current trading channel in order to set a new path and of course back upwards. So other than that, it's going to have some downward pressure on it in the months to come. So mortgage rates do tend to track the 10-year yield. It's way more technical than I know most of the people that are going to ask us any questions or even care about. But the point here is that it's the anticipation of what's going to come next. It's that, okay, well, if Trump's going to be the president and that's who we're inaugurating in January, then this is what we think economically is going to happen. And the markets in kind of like in lockstep all move that direction.
Yeah.
I mean, it was like right away, everyone was like, oh, boom, instant reaction because they're predicting what they think is coming ahead. And it's not a reflection of what's behind you. It's what do I think is coming up ahead, and that's where I'm wagering my dollar.
And that's why I feel that it's still so uncertain, and that's why I see the 10-year rising, because a lot of people would rather, float to safety and know that that's going to be, a secure investment rather than wait and see what's going to happen. But at the same time, until we get some, like I said, some clear data indication of what they're going to be doing actually concrete, then that's when I feel the rate will, the 10-year will start trickling down to match what you were saying. By the time that president takes office, they have a good enough time to be able to roll out whatever they're going to do, or present what they're going to expect to do, and then from there we're going to start seeing more alleviation in the 10-year, I believe.
Yeah, and I think part of what's happening, and I don't have this verified, it's just a suspicion I have from watching the way things move for so many years, almost 2 decades now, is sometimes people take advantage when the market is hot in their favor. Let me pad my account a little bit. Let me just have a little bit more hedge or some more margin because of the uncertainty that I don't want to admit I feel or I see. So it's one thing to know, okay, here's who our president's going to be. Here's the policies. What's the likelihood of those policies being adopted? And then going, you know what? Because I don't know all that, I better hold on a little bit longer or onto a little bit more than normal in case it doesn't happen, or in case it does happen and it has unintended consequences, because we've seen that too. So I think that's some of that at play. I think some of the market activity as far as rates are concerned are like banks hedging their bet and making their position known that they still don't know exactly how this is going to go. So because I don't, you know what? I'm just going to go ahead and take advantage of the market, the rates being higher a little bit, and I'll just take a little bit more for myself and hold on to it.
I think your analysis was straight on.
You can say greedy bank all day long. There's an argument for that as well. But you can also say you got to have, in order to be in lending, you have to have a certain security pad anyways. You have to be able to lend money and all this other rules you have to meet. So you actually better meet the financial litmus test, first of all, the financial stress tests, and then even, pad your coffer a little bit more in case of unforeseen consequences.
So I wrote down right here, cuts versus raising of taxes. And what I feel is that when you cut taxes, you promote more expansion, hiring more jobs, and increase wages or more budget to be able to, allocate towards positive things for the company or whatever. But when you start raising taxes, I feel that it promotes, cutting, firing, can increase wages. So therefore, I feel that, although we don't know what's going to happen, you can already see how if you cut taxes, it promotes more money coming in, which therefore I feel that could be, trickled down to cope with the cost of living, to higher wages, to get more people to have more jobs, maybe expand, open up more businesses, be able to have more expansion. And I feel that is going to be a key thing to be able to fight with inflation. If we know inflation isn't going to go down to zero, and we're never going to have it as low as we want it, it's always going to be there because we print money every single time that we could run into an issue, and then that brings inflation, then I feel that people need to be able to at least cope or come close to be able to fill that gap of what inflation is taken away from their pockets every month.
And that's a good point, and it's because and I just maybe I haven't shared it this way, but it becomes very subjective very quickly, right? Because what the tax cut means to one person means something different to another.
Oh yeah, you bring up a great point.
And I'm not saying that a tax cut is bad for someone, but it could be bad for someone. Yeah. Like maybe a tax cut is great for the company, but the tax cut doesn't translate into hiring more people. It means keeping your wage earners stagnant and stable, and then you increase in your inventory. So you spend your money on something else.
Correct.
That
makes sense.
I'm going to use an example from a long time ago, back when there were lower corporate taxes. I have a friend who owns a shirt printing business, and he used to print for like Walmart.
Right.
So when certain costs of material would go down on the market, they would buy hundreds of thousands of shirts at the blink of an eye because the price of cotton went down today. I'm going to buy 250,000 shirts now. And I'm just going to hold them. They didn't make any new jobs. They didn't hire anybody more. They just said, oh, it's cheaper. I'm going to grab it and hold on to it. and then I'm going to hold on to it for when I do need it. And when I do need it, I will have already bought it for cheaper than it will be in the future.
So you can go ahead and just
right.
control the price.
Right. And again, I'm not saying that that's bad or good. Everyone likes a $5 t-shirt from Walmart, but there's a whole different level of like business acumen that gets deployed when there's tax cuts. And if you are not in business or you don't own a business and you are a wage earner, you're making salary, you're hourly, then that means something different to you too. Maybe you do make some more money. Yeah. We want that too. That money then becomes subjectively spent and used. Am I going to use this extra money to pay down my debt?
Correct.
Am I going to use this money to save or invest or whatever? Or now I can... But yeah, so my point is that once it happens over here on the policy side, it gets to the people side, then it looks like scattershot. It looks like a whole bunch of different ways.
And then
you don't see the impact of that till way down the road, and you look in the rearview mirror, you go, oh, okay, well, yeah, let's look at that.
They all just spend their money,
happen. And I'm going to admit too, some of the stuff that people claim about and they raise their voice about is also true too. Like corporate nepotism, there's going to be some of that. People just do that. People give themselves fat pay raises at the top. They're going to do that too. You know what? They're going to do that. I can't say that they're not going to do that. They just do. So, and at the same time, there's people that are going to just be able to benefit from it, and they're not going to ever grow a company, and they're not ever going to start one, never going to try one, and they just want to have a stable job and feed their kids, and have a home, drive a nice car, enjoy their weekend, enjoy some entertainment or whatever, and that's totally fine too. Yeah. There's absolutely nothing wrong with that. We need some more normalcy in that section too.
No, I hear you. That's good.
Okay. Any other thoughts about this?
No.
The difference between the tax cuts and then what it might add to the deficit or cut or take a chunk out of the deficit, I don't know what that's going to mean yet, because there's also revenue offset. And I don't think we're talking about that enough yet, because maybe there's just not enough known. Yeah. Because there's all these claims being made about, cut this. We're going to do tariffs over here. Well, but then the tariffs are going to cause inflation. But no, the tariffs are going to make the other country pay for it. But they're not going to pay for it, but the company's going to pay. There's all these back and forth.
Back and forth. I know this will happen. That will happen.
But one of the other things that I think we're going to have to see more of is what new revenue comes back to us that left, and then what things can we do on the energy independence side that reduce our costs here that then infiltrate their way into the pipeline of the economy. Drill, baby, drill. So, for example, and again, you can kind of find articles of this on the internet, like the EU already said they're going to buy LNG from us, liquefied natural gas. Okay, well, great. So if we can sell more of that, then that goes in the profit and loss statement of the country, right? So more revenue, and then even if there's some more expenses over here, hopefully there'll be some balance and an offset of those things like you would in normal balancing at P&L. I know it's an oversimplification of the thing. Don't come at me. Example. The point is, you and I don't know yet what all the revenue streams coming back to us will be, or the new ones that are going to be created at the same time that there could be offsets of chunking out deficit, et cetera, et cetera. Ready?
Ready.
All right. We're ready for the last one. More homeowners just started pulling cash out of their properties, Brian. Here's why from CNBC. As the award falls behind you. I'm not sure how that happened. Was that your hand?
I tipped it. No,
you bumped the thing? Wow. Wow, Brian's excited in the studio today. So the housing market continues to befuddle economists and policymakers who expected higher rates would slow buyer demand and cool the entire economy. Instead, the economy is forging ahead. Inflation is still easing, slowing. Employers are still hiring, barring a sharp slowdown. But GDP continues to grow, and we're handing a booming economy to the new administration, and housing affordability has been front and center. So, what do you think about people pulling cash out of their house, beyond the example that you gave us earlier in the show?
Well, if they're pulling money out of their house, we know that's one of the things that homeowners like to do at the end when all their options are exhausted. And for them to say that the economy is booming is just kind of counterintuitive if people are running to their house piggy bank to pull that money to pay down debt, to just cope with the cost of living that's rising, to pay with everyday things.
How would you argue that if you say, well, equity has increased so much recently? So isn't that kind of booming too? It's also, I get your point. I'm not trying to put public pressure on you, but you can see how that can easily be like, well, wait a minute. Isn't that mean it's booming as well? It kind of is.
It is, but in the family and the life level, like when you're there, it doesn't matter if your house is worth that much if you can't pay for your bills, for your stuff.
In a weird way, everyone getting refinances in the threes a couple of years ago allowed prices to run hot and run high really fast. Yeah. But then the Fed increasing interest rates really quickly kind of solidified and put it in concrete. And so now it's like stuck there. So now we have prices stuck, equity that's there that can be tapped in, but at the new price. So it's kind of like a wager of, well, do I want to use my equity on paying off my personal debts or taking cash out for a rainy day or, whatever the reason is, at this much higher elevated rate than what I got in 2021, at 3% or 3.5% or whatever. Some people need to do it. But my point to you, Brian, is that I think that there is the argument to be made where you can really have this either way. You could sit here and we could talk competently about how the economy is not working for a lot of people.
Yeah.
And then we can talk competently about how it's working for a lot of people, because those who are not in the homeownership position, it may not be working out for them.
Yeah, I hear
The people who are, it could be very much working out for them just because they have a house and they have equity. Renters don't have equity at all. So, which way, Western man?
No, I mean, you bring up a great point, and I think you also hit the nail on the head. I mean, it goes both ways, but at the same time, it's just difficult to kind of put together and actually, say like, oh, well, this is how things are going to go.
What's a case where you would argue that someone should be considering a cash out refinance? What conditions need to exist for you to advocate that someone should do a cash out refinance right now?
So if you know that, you're depleting your savings to just cope with whatever it is that you have to pay a month, maybe that's one alarm that you should be like, hey, maybe I do need a little bit more help because I don't know how much I could keep taking from over here. If my job isn't able to, pick up the large weight of, all my bills and I have to tap into my savings or just my regular bank account, then I think that's when you need to start considering other options or, alternatives to your income.
Okay.
Can you pick up a second job or, can you add additional income by doing something else, side job, side gig or whatever it might be. But I think that once you start feeling that pinch, like, oh, I'm paying a little bit more than I'm used to paying, or, hey, I'm digging into my savings a little bit more than I should. That's when you need to just, have a real conversation with yourself, your spouse, and just say, hey, like, maybe we should allocate some of that equity that we're not using, that we can afford to pay a little bit more, and it could alleviate us on, on the monthly expenses that we're paying for credit cards, for auto loans, for personal loans. So I think once you have that, oh crap, things are getting expensive, that's when I think you should start just inviting the idea of what it would look like if you take some money out, or if you wipe off all your debt and just, live off of one day in your house.
Okay, quick pivot. Let's have the counter argument. What are some reasons that people should not do a cash out at all?
Well, if you have no financial burden, if you're just taking that money out to just, take it out, go on vacation, and even sometimes do repairs or remodels that might not give you the best appreciation in your equity or, raising your value, or if there's really no intended use for it that is either going to, make you more money, subsidize a payment, or alleviate debt in one way that you couldn't alleviate it another through another means of financial, then I think that's when you shouldn't do it. If you're just doing it to do it, like, hey, I just want to have 100,000 in my bank account, or hey, I just want to, go on a freaking 6-month vacation trip. If you're utilizing for personal, for how do I say it, for entertainment, or if you just want to buy yourself something nice. I was at the barbershop the other day when my barber was like, hey, I had one of my clients come all excited because he cashed out, refinanced his house to buy himself a Dodge Hellcat. Like he spent like $65,000. I'm like, wow, that's probably the dumbest thing you can never do ever, because you have one debt to pay off another debt. And
I mean, that is also the case for cash out, but you're saying in this case it's a depreciating asset.
Yeah, I mean, like if you're not getting something to propel you higher, or if it's not taking you out from a hole that you really need to, then why are you going to add on more to your monthly payment?
Wow. Okay. I wanted to ask, because I know there's two sides of the coin on that.
But then someone could also argue, it's my money, I'll take it all out because it's going to get evaporated eventually. You know
what? Yeah, there is always kind of always that, like, I'm going to do what I want.
Touch it. I'm never going to touch it, no matter what, even if there's a fire.
Yeah. There is the whole kind of like, I'm going to do whatever I want. Andy, you don't need to tell me.
There's everybody wants to do something there. Everybody's going to do whatever they want at the end of the day. The one thing I know is that everybody knows that house prices are expensive. Monthly prices are expensive. Like, that's the one thing we could all agree on. Whatever you do with your equity, whatever you decide to do with your property, some people don't ever want to touch them. They don't ever want to take they don't even want to invest in real estate because I don't want to be a landlord. I don't want to deal with, repairs. Whatever it might be, everybody has a plan. Everybody wants to do something. Everybody has different interests in what they're going to do with their money, life decisions. Just the one thing I know we can all agree in is housing and affordability.
Yeah. Well, one of the things I want to make sure I mention in this, because I think it's important to know, is the quote that was here at the very bottom, and this is from Jerome Powell, says, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do. And I underlined getting those rates normalized. I said this earlier in the show. That's a signal. It means expect to stay close to where we're at, and we basically got a reset. I mean, I don't mean no joke by like the whole Great Reset and all that kind of thing, but like we basically got a rate reset from the rampant spending of the last 4 years, and prices are not returning to where they are. They're just slowing in their acceleration.
So I'm going to go back to what you said about normalized. So they're saying that over and over again, but they're not using lowering, dropping, coming down. It's going to get cheaper. No. None of those adjectives are being used because this is the new normal. This is what we're going to get used to. This is the new thing. Like if they were arguing that, hey, we're going to bring rates down, they're going to come lower, that they'd be saying that in their language, but they're not. And that's alarming.
Yeah.
And that's very alarming because they're trying to make this the norm. Like, hey, this is okay. We're fine. This is a new standard.
Yeah. It's that kind of thing that makes me cautious when we talk about the Fed. I know we talk very, I'd say, semi-casually.
Of course.
Yeah, we got my notes and I got the things I read and I'll make the points I want to make. But I also sometimes really just caution because they can make prepared statements and they know they're going to be on the record. And so you also then choose your words very closely at that point too. I mean, you're still talking about a person who, they face the public, they face the press when they make their federal rate decisions, but they also have to testify. You also have to testify to Congress. And so, you are going to be held to account. Now, that varies depending on kind of who's in power and, what kind of things they're trying to focus on. But my point is that they have to choose their words very carefully.
I agree.
And when you're using this type of talking point, it is more of a signal for what's to come than the optimism of returning to where we came from.
Well, there's just such a pivot out from that. It's like, well, we never said they were going to get lower. We just meant that, these prices are going to become the new normal.
Well, what would have been nice here is to have said that this has accomplished our goal of a soft landing. But I'm noticing that that's been missing from a lot of Fed commentary recently. Not me over here remembering they said soft landing for like 3 years straight.
But okay, we've just been waiting on the Fed for about 4 years now.
Soft landing. Yeah, I took my P&L and I threw it out the window and it had a soft landing into the ditch, and then I burned it
to the fire.
Lit it on fire. There you go. Brian, favorite part of the show.
Favorite part of the show. Okay. I think it's going to be if Fed isn't cutting rates, if Fed's cutting rates, why aren't mortgages rates rising?
Why are they rising? Yeah. Okay, why? Why is that? Why did you pick that out of all this stuff?
Well, because I feel that everybody, once they speak about the Fed, they don't know what the Fed does. They just know that the Fed, every single time a realtor or lender goes up to the freaking, story or, to tell their audience is like, hey, the Fed's going to drop rates. Unfortunately, that sends out a message that they're the ones that control all interest rates, and therefore, they're not going to research anything after that. So the Fed is very misunderstood in their function of what they do for the economy, that I feel that this kind of shunned the light on, like, hey, just because they drop rates doesn't mean that mortgages are going to drop, tank, and it's all freaking peaches. No, it's not. We've seen it. We're experiencing it right now.
Yep.
So therefore, I feel that was perfectly put so that people understand that the Fed doesn't control mortgage rates. They only control the way that the banks borrow money from each other. And then that correlates into everything else.
All right. Well, I have one that's similar but a little bit different, and it is
whatever.
No. It's about it's about Jerome Powell, but it's from the final article about the homeowners pulling cash out because Jerome Powell was talking about getting the rates normalized, and I think that it is going to be a little bit later than expected that the Fed finally achieves their policy outcomes they wanted. There's a lot of forecasting that by 2024 and 2025 we're going to see this. I think that's honestly going to roll over to be more like 2026, 2027.
For what it is, I think Jerome Powell has handled himself very well under all the scrutiny, all the fire, all the stuff that he gets. Like, to be in that position, go up to the podium, answer those questions, and then strategically be able to give answers that doesn't, open up the door for a whole bunch of malinterpretation. It's just he's so short with what he says, but what he says holds a lot of weight. If that makes sense.
Yeah, no, it does. But you got to remember, like, part of their plan was to get unemployment up, like way up, and it had to get way up, and it did. And so you have to know. And I'm not sitting here from a place of admiration toward him.
Not at all.
I'm saying that I respect him. I do not want that job. I am critical, but as much as I will be complimentary, because in order to make certain things happen in your policy outcomes, you have to know that that's going to bring some pain along the way. They said that,
100%,
and they admitted it. I'm making the point right now to conclude that they are just going to see it later than they initially thought. It's not going to be 2024 and 2025. I think it's going to be more like 2026, 2027, even with new policies coming in with the new administration. All that's going to take time to roll out and then take effect.
And that's what I appreciate about the tone that they take, that it's not all peachy. It's going to be great. It's going to be good. They're telling you how it is and how it's coming, and they're not afraid to tell you what you don't want to hear. Yeah. When the market's waiting for one answer and they go and deliver another, like, that's their job. And I think they're doing a very, very good job at it.
I think they're doing. They're passing for now. It's certainly not a fail. That's for sure.
Yeah,
it's not a fail.
I'm not saying they're doing great, but
it's not an A+.
They're getting the job done one way or another.
Not an A+. But you did an A+ today. Thanks for joining me on the show, man.
Of course.
Thank you all for watching the Mortgage Heroes Weekly Podcast. Remember to subscribe to the channel, like this video, and send any segment of this show to a friend or loved one to help them win in mortgage and real estate. Brian, myself, and maybe Will next week. We'll see. We'll see if we got him next week. But anyways, we'll be back next week with another great show. Thanks for watching. We'll see you next time.
Bye, guys.